Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for December 14th, 2020. Please see our disclaimer for important information. As we get closer to the traditional holiday break, we found that last week our markets lacked a little bit of direction. We had a bit of a drop in the indices last week. The Dow Jones was down 0.6%, S&P was down 1%, NASDAQ was down 0.7%, and we saw declines in large cap areas of the market as well as some cyclical areas of the market. Economic data a little bit mixed as we kind of head into this break. On the plus side, we had University of Michigan Consumer Sentiment Index surprised on the upside. In fact, the market was expecting a drop, so that was particularly good. Initial claims were up, unfortunately, though. They jumped 137,000 to 853,000 last week, which is a 3-month high. So we've seen a little bit of backwardation in that area. And we've also got a huge surge in cases, and I point you to the charts of the week package in which we've been consistently putting the COVID tracker chart in there that shows the rise in case volume, which has been fairly consistent over the last several weeks. And that's resulted in additional lockdowns. Case in point, New York City shutting down its indoor dining altogether. There are other areas that are kind of responding in similar fashion. So we've had a cutback in retail jobs, hospitality jobs. I imagine we'll see some curbs in spending, even though there's a pent-up desire to spend, but some of the curbs will probably and restrictions will probably put a lid on that. Consumer prices were actually higher than expected. They were up 0.2% in November, but the year-over-year trend is actually showing a bit of a moderation. So some puts and takes in the data. In fact, that resulted in Treasury yields that kind of edged a little bit lower. 10-year Treasury was 90 basis points, and that's down about 7 basis points from what we've seen over several weeks as it was kind of inching up towards 1%. And credit spreads in the fixed income market were a little changed, but broadly speaking, we have, I'll just kind of start with the equity market, the S&P 500 for the quarter. Again, this is starting October 1 is up about 9%, 8.9. Dow Jones up 8.2. NASDAQ is up 10.8%. Russell 2000, representing small caps, is up almost 27%. EFA, which is the European index, including Far East and Asia, about 12.7%. I'm just looking at this year-to-date figure. This looks right at 2.6% year-to-date for the EFA, whereas the domestic indices, the S&P's up 13.3%, Dow's up about 5.3%, NASDAQ is up about 38% for the year, and the Russell 2000's up about 14.6%. Barclays Aggregate Bond Index, and this is kind of intermediate term bonds, is up about a little over 7% for the year. Basically a little bit above flat for the quarter. And we've seen reasonable strength both this quarter in high yield as well as leveraged loans. Real estate is still down for the year, although if you look at the kind of the alternatives basket, which includes real estate, MLPs, multi-limited partnerships, and such, they've all had really good quarter by and large. Crude prices are kind of definitely settled in about $47 a barrel, although crude prices are still down about 24% for the year. The dollar, we talked about that a little bit in the market minutes, in the charts of the week. We've got some charts on the dollar. Dollar is down 3% for the quarter, and it's down almost 6% for the year. So we've seen notable weakness in the dollar, which has led a little bit to some strength in emerging markets. Emerging market equities were up 16% for the quarter, and they're up almost 13% for the year. So that's a little bit going on there with at least the data. Um, I would say basically that we've had a little bit of a soft spot in some of the data. I told you about jobless claims. And then we still have some political unfinished business, if you will, as much as we're dying to get past the ramifications of this election. But obviously, we've got stimulus negotiations, which are underway on a kind of a stopgap bill. There's a lot of things going on. We've got a potential government shutdown looming, which I honestly don't think is going to lead to a shutdown. I think there's going to be basically a continuation bill that is put forth just to keep the government funded. And then, of course, we got the elections in Georgia, and a lot is hinging on that with regard to potential tax increases and other types of environmental legislation, which I do think we're going to get perhaps anyway with the Biden presidency. But it just essentially there's some variables on the political front that are still out there. I do think we'll get some stimulus. What's being discussed right now is something on the order of $900 billion, provide benefits in a lot of areas. I think there's a lot of calls for individual stimulus as well as help for small business. Clearly some calls for action on the state and local funding side, and some of the data out there on that is pretty profound. I mean, some large municipalities are going to be down, 25% or thereabouts in terms of tax revenues, in next year, and that's going to put a huge crimp on spending and whatnot. But so we've got these things that kind of weigh on sentiment a little bit. Volatility's increased a little bit, although we're well below the highs. And the market's pricing in a fair amount of earnings growth next year. And I think we got to watch and be careful about not getting carried away with that. We've got a high multiple on high earnings. We've got $180 a share in 2021 EPS for the S&P 500, which puts the market at about 22 times earnings, which is really in kind of high altitude range for us. But on the flip side, you've got a lot of things that you could point to say, hey, listen, we're in good shape. We got low interest rates. We know the economy is going to recover. We expect a gradual recovery next year. I know that we're going to get stimulus, and I think with all of the cash that's sitting on balance sheets for corporate America right now, I mean, clearly we had a lot of companies that were curbing their dividends or eliminating dividends for the time being. Now, a lot of them are coming back and reinstating those dividends, but we've had less share repurchase at a time where there's clearly an appetite for initial public offerings because we've seen a real big boom in that area. So there's clearly liquidity in the system that's trying to find a home. And I think what we're going to see next year is an increase in deployment of cash into the market. And I think, from a stock standpoint, that could boost equity supply. And buybacks were down like 40% year over year for the first 9 months of this year. And we could see, the S&P has come up. The index has gone up, and I think that's giving people a little bit more comfort to be able to say comfort within the boardroom to make these kinds of decisions to deploy cash. And we know that cash levels are about 36% higher year to date to roughly 2.5 trillion than they were in 2019, and we're expected to have a fairly strong response in free cash flow, which will give people the ability to do these kinds of things. So, since September 23rd, the S&P is up 14%. Value is up 16, almost 17%. So we've had recovery in value, even though value sits as a huge differential to growth in terms of a style. The Russell 2000 index is up 31%, which is phenomenal. But I think that, and this comes from an article in Barron's over the weekend, that, the high momentum type investing may have, kind of fallen out of, of favor, if you will, for the time being. And obviously in that time, we've seen a huge rise in the 10-year Treasury from about 70 basis points to, like I said, we're around 90 basis points now. And then, small caps are beginning to recover too. And we've had, a fairly large drop in earnings estimates for the S&P 600 between, basically the end of last year and the third quarter of this year. And I mean, almost more than double the drop in estimates that we've seen for the S&P 500. But, having said that, the valuations on small cap are still much more attractive. And then, I also want to talk about international stocks, because when you talk about what we're doing as a firm, some of the things that I'm looking at personally are, that rotation, perhaps a little bit from growth to value, from large cap to small cap, rotation, a little bit more, increasing that ratio of international stocks to domestic stocks. And part of that involves perhaps taking some profits on the domestic side. But, basically with international stocks, we've talked about the dollar weakness. That's good mechanically for, a lot of international stocks. Certainly for emerging markets, a weak dollar is good for commodities. It's good for emerging markets. Because of a lot of the credits that being priced in dollars, and commodities from the standpoint that a lot of the commodity baskets are priced in dollars. For U.S. firms, that what that implies is a weaker dollar, tends to cause us to run the risk of importing inflation. As our dollar is weaker, so what we're importing runs the risk of being more expensive. And conversely, for components of the S&P 500 that are doing business abroad, those exports are clearly from the U.S. to other markets are clearly cheaper, so and arguably more attractive. So that there's benefits, for firms that are exporting. But making the case for international equities, you've got a weak dollar, and you actually have stronger growth if you look at the OECD estimates and IMF and those. I mean, the global GDP is expected to grow over 5%, almost 5.5% next year. The European Union is expected to grow, almost as much, and the U.S. is only expected to grow about 3.8. So the expectations for global growth are actually greater. And even emerging markets, which typically have higher growth rates, EM is expected to grow, almost 6.5%. And we're getting good news out of parts of the world like Europe. We're getting more stimulus. They're going to increase, the quantitative easing, which is basically asset purchases by, almost more than $500 billion. And then we've also got a nearly, $1 trillion fiscal stimulus package over in the EU that's in the works. And, and we've got lower valuations, just as we do arguably in a lot of areas of small cap, which I think is actually fairly attractive. So another thing that I'm watching, which is interesting kind of as a side note, but it does have some impact here, is Tesla is going to be added to the S&P 500. So that what does that mean? Well, one, Tesla's up, almost 700% this year, and it's trading 160 times next year's earnings. And you've already got an S&P 500 where the 5 largest companies in the index account for not quite, but almost a quarter of the index, and top 10 make up 28%. And if you add Tesla to that, it's obviously going to make the market more expensive. Tesla's had a tremendous rise, and it creates a conundrum, because if you're an index manager, and we know that we have over almost $5.5 trillion in index funds that track the S&P 500. that you're going to have a lot of buying that's going to need to happen in Tesla. So I think the index, which is already high, when you get that Tesla inclusion, it's just going to be more expensive. Valuations are going to be more out of line, and possibly make that index incrementally a little bit more volatile. So that's that. On the dollar side, I mean, we've talked about that. It's obviously been sliding ever since the height of the pandemic. There's a lot of different things going on with the dollar. You've got global recovery, that's not necessarily paralleled with what the U.S. is doing. We've seen kind of, European bonds kind of begin to track a little bit more closely with treasuries as a result. And then obviously, like I said before, you've seen a really strong response in emerging markets, which I think is apt to continue. Another thing we talked about in charts of the week was this whole notion of when are we going to get, inflation. And, I think the near-term prospects for inflation are not nearly as good as they are if you look out over the kind of the 12 to 18 month time frame. But you are seeing pockets of this. We know the manufacturing sector is doing well. We know construction is doing well. A couple of charts in the charts of the week pack this week include, metals and lumber prices are up. Iron ore prices are up. We know copper, the ratio of copper to gold prices is out of line. In fact, we've got several indicators that are like more than a full standard deviation above their norm. So we've got a lot of these commodity baskets that are a bit out of whack. But metals are doing strong. China is in recovery mode now. They seemingly have passed this hard phase of this pandemic, and so they account for almost half the demand in a lot of these commodities, these metals, I should say. Anyway, so we've got inputs into the process, the producer prices, if you will, the inputs into these original equipment manufacturers like durable goods, which we know the demand and pricing is going up in durable goods. We've got a chart of that as well. So we've got a lot of cross currents in terms of producer inflation that we'll need to pay attention to. It's not translated into consumer inflation just yet, but in any case, let's see, what else do I want to say on metals? I think I'm good on the metal side. From a household wealth side, I mean, we know that the housing market has really done exceptionally well. Household wealth is up 3.8 trillion to a record, during the third quarter to a record 123, almost 124 trillion. Equity wealth jumped about 3 trillion, 2.8, and then, record low mortgages. Home prices were up 7% in the 12 months ended December. That's been a real strong spot, and I think in some respects kind of a saving grace for homeowners that gives them more confidence to spend, knowing that their housing values are going up. But in any case, I do think with the Fed, we have a chart in this as well, but the Fed is got to step up. I mean, there's a real dependency on the Federal Reserve, as it relates back to homeowners and mortgage rates. And the reason why housing is really strong is we've got low rates and low inflation. But, it's going to require the Fed continuing to be out there purchasing assets, which creates a demand for those assets, which drives their prices up and keeps yields low, because yields move opposite from prices. So as long as the Fed is going to be active in buying those fixed income assets, I think it's going to help keep those rates low, and will probably help kind of suppress yields overall, which will continue to help fuel or fan the flames, if you will, for the mortgage market and for the housing market. But really just want to summarize a few things here before we break this week. Observations. We talked about these kind of lockdowns and restrictions. It is taking a toll on the labor market. We saw it in the last reading. We're at a 3-month high there for initial jobless claims. And it is somewhat regionalized. We got some areas that are worse than others. We talked about the international investing landscape. We know that the European Central Bank is going to be really active in buying assets and injecting liquidity into the market. We've got corporate profits, which should jump in the fourth quarter, and I think that leads to a better 2021. I think we could probably see a really high number in profits in the fourth quarter. But I do think expectations in 2021 might be a tad high. First quarter growth is expected to be up about 15%, and then like over 40% in the second quarter, and then like over 20% for the year. And I think we've just got to hit the caution button a little bit. And I just think that we've got there are some things that we just don't know. We're just on the eve of this vaccine rollout, with the first doses actually hitting the ground this week. If we have rising interest rates at the end of 2021, that could really stall, I think, a little bit of this momentum, not only on the profit side, but potentially in the equity market as well. But we've got really high investor optimism. I think that we're apt to see some shocks in the market. I'm not sure that we're apt for a huge reversal, but I do think that having some reasonable consolidation here heading into the new year probably makes some sense. But improving conditions overall next year should probably help cyclical, and as I already said, international stocks for sure. But we'll still need to find out what happens in Georgia in about 3 weeks, and that's going to be important in determining kind of where tax policy is going to go, and is that going to take more money out of back pockets of American consumers, and to what extent is it going to hurt corporate earnings per share after tax, right? So as far as interest rates go, I think interest rates will probably move in kind of an uneven way, but with a bias towards increasing. And I think that will dovetail with longer term economic growth and growth prospects. And we know that the central bankers are really clearly focused on wanting to have more inflation out there, and that's part of the reason why I think that effort is going to actually translate into inflation, certainly as we head into 2022. But I think really the things that kind of could trip us up in our markets are one, the pace of tax policy and the political risks incumbent with perhaps not having a divided government, and then growing inflation pressures, which would lead to rising interest rates. Those would be the things that would that kind of stick out the most as far as what we should be paying attention to here in the first half of 2021. Please feel free to reach out to us if you have any questions or comments, and we look forward to seeing you soon. Take care.